Welcome to Market Call. I'm Marilla Fernandez. Rebecca Teltscher on the show today. She's portfolio manager at Newhaven Asset Management. She'll take your questions on Canadian dividend stocks. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Rebecca, thanks for joining us. Good to see you.
Nice to see you.
We had the U.S. unemployment rate drop for June. Why do you think employment is still strong in the U.S., given what we thought would be a slower time because of tariffs?
So I actually don't find the employment numbers as strong as what's posted when you start reading through it. So first, there's conflicting job reports. Yesterday's ADP number showed a miss, like a loss of, I think it was 33,000 jobs. Today's job report beat expectations, but again, expectations have come down. So if you look at on a year-to-date basis from January to June 30th, there was about 780 new jobs this year. If you compare that to 2023, there was 1.5 million. So we're looking at about half of the amount of new jobs being created versus, less than 2 years ago. And then if you look at the details of the report, again, it's not very optimistic. A lot of it is jobs numbers. So outside of the healthcare sector, there's not that many industries that are hiring. A lot of it is, again, government jobs, whether it's at the state level or municipal level. And they're not usually, government jobs are just the least productive in terms of economic productivity.
Okay, so let's talk about whether or not you expect it to continue to slide maybe in the second half of the year. And we have to factor in that July 9th is the next tariff deadline, right?
Yeah, again, so, we are being a little bit more careful, positioning ourselves a little bit more conservative. I think the past quarter has seen exceptional market growth when it comes to the economic underlying data. We've seen that being mixed or weak. So when it comes to, the disconnect between the market and the economy, that seems to have widened, and then you add in more uncertainty with regards to geopolitical tensions, and then you add tariff uncertainty. So there's a lot of things to look out for, and then the market just keeps making record highs. So, we see that. We're a little bit concerned.
Why do you think that is? Why do you think we're seeing that run up in the markets? All of them had record closes yesterday, the big markets. Today, the TSX has already pushed up for a moment past 27,000. And I know that you think a pullback is inevitable. So explain what we're seeing in the markets and why you think there's a disconnect with what you're seeing.
I wish I had the answer for you. I mean, there's a lot of different reasons why that could be happening. One, I think bad economic news could mean that investors think that there's going to be a rate cut. For example, after today's job numbers, I think a rate cut in the U.S. is probably not going to happen this summer. But, any negative news could mean that a potential saving from the Federal Reserve. Also, we haven't really had a real recession since, 08, 09. So in the past 15 years, I think investors got used to the idea of whenever there's any kind of economic weakness, either the government or central banks are going to swoop in and save the day, alleviating what could be a potential economic downturn. But when I look at debt levels continuing to rise, I mean, there's only a limit to how much more we can continue this trajectory of government spending, infinitely to support the economy. So I do think, we are seeing signs that the economy is slowing down. And I just think for us, it's better to be cautious from here. I think it's unlikely that the markets are going to continue posting record highs in the second half of this year, just given all the risks that we talked about before and just given what current valuations are in the market.
Got it. Okay, we are going to take a quick break. We'll line up some phone calls for Rebecca. She's with Newhaven Asset Management, taking your questions on Canadian dividend stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Thanks again for joining us. Let's go to an email to start. Mary has written in. She says, could I have Rebecca's thoughts on Searia?
Great question. We own the name. We like the name. Prior to any of the noise with the tariffs, they were doing a really good job. They had the Searia 1 initiative where they were going to increase their output and increase their margins over time, and they had done a really good job of executing that. So you could see on the chart, if you see like the rise in 2024, that's when they had the Searia 1 initiative. They were doing everything they were going to say, everything that they said they were going to do, and they were doing it well. And then all of a sudden, it became the poster child for tariffs because Searia, like many other manufacturers, they had a lot of manufacturing in Canada and Mexico and abroad in Asia, and a lot of their sales were going to the U.S. So it became a poster child for tariffs. We didn't really buy into that because a lot of their products are FDA regulated, and so under previous legislations, they were not subject to tariffs anyways. And they had the flexibility to move their production if needed. So you saw them move some of their production into the U.S.
Okay.
That being said, aging demographics. So I didn't say what they did, but Searia does wheelchair lifts, wheelchair ramps, stair lifts, home elevators. The whole idea is population is aging. People want to age at home for longer, and so they supply the products to help you age at home for longer and in a safer way. So again, even though it's a discretionary name, really it's needs-based, not wants-based. If you get to a point where you can't walk up the stairs and you need to install a chairlift, it has to happen right away. So it's not really discretionary. You can't really hold off on that kind of spending. They also have another segment where they do patient care, so slings and mattresses and movable beds and things like that. So again, we own it. A lot of that tariff noise is behind them, and I think right now we could just focus on them continuing to execute.
Got it. So they got mixed up, as you say, in the tariff noise, but they've got a solid underlying way of a business that's going to grow. Yeah, so either if tariffs did come to fruition, they were going to be able to pass most of those costs through. Again, needs-based, not necessarily wants-based, but again, FDA-regulated products, those would have been tariff-free anyways. I think there was a bunch of uncertainty if there was going to be a blanket tariff statement, tariffs, but that didn't seem to be the case. So the stock has rebounded, not back to their previous highs, but getting there. So we continue to own it. Got it. Okay, let's go to the phone lines. Chris is on the line from Victoria, BC. Hi, Chris.
Oh, good morning, Rebecca. Good morning, Morella.
Good morning.
Rebecca, I'm wondering if you're aware of QSR, Restaurant Brand International's CEO's compensation plan and how there's some pretty lofty targets for the company and the stock. I think 10% a year for 5 years, and the CEO will essentially, for lack of a better phrase, receive a very large payout for that. And I'm wondering if you're aware of that, and then in general, what your opinion is on restaurant brands. Thank you.
Okay, so restaurant brands, do you worry about, as we talked about, discretionary spending in the next sort of 6 months or so?
Yeah, so unfortunately, I can't speak to the compensation plan. It's not a stock we own, so I don't follow it as closely with regards to CEO compensation arrangements. But what I can talk about is the space in general. Restaurant brands, again, I'm nervous about the consumer, particularly in Canada, also in the United States. We are dealing with a highly indebted consumer that's a little bit more cautious on their spending. If restaurant brands was just Tim Hortons, I would be okay with that because I like the trade down economics with regards to, let's just say, consumers that are used to buying their Starbucks coffee is now going to switch to a Tim Hortons. So I think there's that trade down economics that works. Where I'm a little bit more concerned is their larger business, which is Burger King, that has suffered. They're still closing down stores. Lots of competition in the space. Worries about margins and things like that. So again, worry about the consumer and consumer discretionary space in general. So for those reasons, we don't own that stock right now.
Got it. Okay, let's go back to the phone lines. John's on the line from London, Ontario. Hi, John.
Hi, Morella. Thanks for taking my call. Hello, Rebecca. Good color choice. Fuchsia matches your.
We offset each other there. We go.
Great.
Our youngest has just turned 18.
Okay.
And so he's not a hoodlum anymore. They expect results now. So I'm decumulating, and he has an FHSA, TFSA, RRSP. Could you pick a sector with a dividend and a stock, maybe a stock within that sector? So when I'm a dusty pile of bones, he says, I bought this great stock in 2025 because of Rebecca Teltscher. Thanks very much.
Oh, I'm sure he's going to write it down, too. Okay, so very young, lots of room ahead of him. Would you pick something that would appeal to the age group just so that there's sort of an interest in it besides something that they might not be interested in? Or would you just go with a solid
I'd probably just
pick?
go with a solid classic pick. But first I want to say you are a fantastic parent for setting your son up for success at such a young age. I mean, I'm a daughter of two immigrant parents that, did not know what a TFSA or RSP was. And so I kind of learned that on my own and started in my late 20s. So I was a little bit further ahead. So, I mean, congratulations to you for that. I think that's fantastic. And a great question because, again, young investors don't care as much about dividend stocks. But they're really important. And I think the earlier you start, the more you get that compounding effect that really takes place after 10, 20, 30 years of investing. You get to reinvest those dividends and compound those over time. And that power of compounding is really a powerful tool. So
I also think it's just great that they see their money making money in a very specific way, as opposed to just the stock going up and the value going up. They're actually getting paid a dividend without really doing anything.
Absolutely. It's an income that is predictable and dependable. And when you're not spending it in your retirement, you get to reinvest it, and then your dividends are making dividends at the end of the day. And, at the end of the day, you're only making money once you sell if you're investing in something that doesn't produce an income. Whereas here, it's like you're collecting rent. So that's why we like dividend payers. And I mean, we could talk a whole hour about why we like dividends, but let's get into a stock specific. I would probably, again, choosing one stock, I don't know. I like a diversified portfolio. I would probably, based on today's valuations, I would go with a CNQ. I think under $50, premium assets, an oil, the largest oil and gas company in Canada. You're not paying a premium anymore for owning premium assets with a low decline rate. They have done a phenomenal job of giving money back to their shareholders through buybacks, dividend increases. They're, starting in 2026, they're going to be paying back 100% of their free cash flow in terms of dividends and buybacks. The other one I would go with, but it's a little bit expensive now, would be Fortis. So, your utility, your stable utility that's growing 5 to 7% a year. It's a little bit expensive now, so I would maybe wait to see if you can get it at a better price, but that's a stock you want to own for the next, 50 years. Longest track record in Canada in terms of dividend increases, and diversified jurisdictions. And we were going to talk about this later on, but the increase in power demand is growing exponentially right now. So I think AI stocks are this sexy play, but this is really you're still getting that exposure, but in a safer way by owning the companies that produce the power.
Yeah, the complement play. Okay, we do have to take a quick break. We hope that helps out our new investor. We're going to be back with Rebecca in a moment. She's taking your questions on Canadian dividend stocks. Stay tuned. Welcome back, and thanks for joining us here on Market Call. Let's go to Alan, who's on the line from Victoria, BC. Hi, Alan.
Oh, hello. Good morning. My question is on Exchange Income Corporation. It's hit recent new highs, and it's posed another deal. Your opinion, please.
Yeah, good question. It's a name we've been following for a few years. Really like the name. We almost got into it last year when its yield was almost 6%. It was looking really attractive, and unfortunately we missed the boat because, as you said, it's making all-time highs. The dividend yield is, back at 4.2%. It's doing all the right things. It's growing its dividend. It operates, has a manufacturing business. It has a business, an aviation business. Well, we don't usually like the aviation space, but in this case we do because they operate in a lot of First Nation territories in northern Canada. They're often the only airline there. They basically have a monopoly on the entire space. They train, Indigenous pilots at a young age that, and then there's a continuity there. So So they don't have the same pilot shortage that, let's just say, the rest of North America is facing. So really good company. I would say the main reason we didn't buy into it is that, we feel the owner and CEO is, the brains behind this business. And we just wanted a little bit more clarity on their continuity plan as he gets a little bit older. I mean, he's still a younger guy, but, we just like to see, a team that are sourcing it. But again, it's a name we keep an eye out. It's a bit expensive to buy it here with a 4.2% yield, but definitely something we're keeping our eye out. I think it's a good business, good underlying companies that they own.
Got it. Okay, Alan, I hope that helps you out. Let's move on to another caller, another Alan, this one from Fenwick, Ontario, with his question. Hi, Alan.
Hi there. Good afternoon. I'm calling about Parkland Corporation. Parkland has a takeover bid of $44 and has been approved by the stockholders, yet the stock's still trading under $39. I just don't understand what's going on there.
Okay, thank you for the question. So Sunoco put the bid out. The shareholders voted end of June and voted in favor of I think it was $9.1 billion. So sometimes you see that happen, right, where you've got the offer, they've accepted it, and the stock's not really doing anything. What could be happening here?
Oh, there's a lot happening with Parkland, and I don't think we have time to go into all of that. But I mean, it really started with the proxy battle between Simpson Oil and Parkland's existing management. And what ended up happening was that it looked like there was that proxy battle. It looked like Simpson Oil was going to win that proxy battle, and the existing management accepted a deal to take the firm over right before essentially that management team, that existing board would have been ousted. So I think, the reason the stock is trading under the deal is, one, the deal was not that amazing of a takeout price. You generally want to see a higher takeout price for a company of that size with those kind of assets. But it was good enough that it put Simpson Oil in an uncomfortable situation in the sense that they really need to, if that deal doesn't go through, they need to really deliver over 20% growth. But I think Simpson Oil at this point is going to fight it through legislation. The other thing, too, is this would have to go through regulatory deals. We said it from day one that if a U.S. company were to come and buy Parkland, there could be regulatory issues or they would have to divest. But at this point, I think it's being priced in that there's a chance that this deal does not go through because that proxy battle is still ongoing.
Got it. So as you mentioned, a lot to unpack, and that could be the stock sort of waiting to find out how it all ends up.
I don't think it's the end of the story when it comes to Sunoco buying Parkland. I think Simpson Oil is going to have their say, and I don't know what the result is, but it's not over.
Got it. Okay. Let's move on to Jacques, who's calling from Toronto with a question. Hi, Jacques.
Hello, good afternoon. I'd just like to ask your guest about Nova Scotia. Where is it going by the end of the year? Thank you very much, and have a nice afternoon.
Okay, so Scotia Bank is what he's asking about. Let's have a look at that line right there. That's 74.94 today. What's your take on Scotia Bank?
So Bank of Nova Scotia, I believe, is the big bank that underperformed this year relative to the others, but it did have a big move last year. It was up like 23 or 24% last year. This year, I think it's down 2.5% on a price basis, not total return. It's right now, I think they're in a transition phase, and I think it's going to take a while for them to sort things out. So they were known as the international bank. They had a lot of international exposure through Caribbean, South America. They've been slowly selling off some of those international assets, and this year they made an acquisition into the U.S. I believe they bought a portion of KeyCorp, so they bought a position of that. So they're trying to increase their presence in the United States. If you compare that to some other banks, they already have big presence in the United States. TD, BMO, Royal as well through their capital markets. Like, they all have U.S. exposure. So Scotiabank's a little bit late on the game. They're selling down their international, buying more U.S. So I think, where are they going from here? I think it's a little bit uncertain. They did have management, transition. I think it was last year or 2 years ago. So again, I think it's going to be a while. I don't think, the stock's going I don't think the company's going anywhere. So I think it's a good company, but maybe in terms of a stock, I think if you have a long-term time horizon, it does have the highest yield. So I think it's okay here, but I'm a little bit nervous on all the banks right now, to be honest. But I think, to 5-year time horizon, sure. But I think we're waiting to see a little bit more clarity on what Scotia's direction is from here.
Was it regulatory hurdles or what was not working out for them in sort of Latin Central America? Do you remember?
I think their margins were just not there,
Yeah.
and just constantly disappointing, estimates. But
Okay, so they're pulling back from there. Okay, let's get to another caller. Anita is on the line today from Markham, Ontario. Hi, Anita.
Hi, good afternoon. Thank you so much for taking my call. Can you hear me?
We can hear you, yep.
Oh, okay. My question is on Magna. I've been owning that for a while now, and needless to say, it's not doing very well, especially with the tariffs on the artists. So I was just wondering what your thoughts are in this company and whether I should continue holding on to it.
Okay, so let's have a look at the Magna chart now. It's at 56.48. Today, obviously, took a big hit with the announcement of tariffs on vehicles, some of it exempt under CUSMA, some of it not, but it hasn't quite recovered. What's your take on whether it could? And we might know more sort of end of July when the negotiations between Canada and the U.S. are supposed to be done.
I am very hesitant on Magna. I think actually if you look on a very short-term basis, that recovery has been very sharp and quick. And it's almost factoring in, the abolition of tariffs completely, but that I don't think is the case, or we need more clarity before seeing what the case is with regards to the auto sector. So I don't think, that the tariff story is over. And then the other large story with Magna is, the auto industry is just highly cyclical and dependent on the health of the economy. We are seeing signs that the economy is slowing or weakening. There is the possibility of a recession coming up, and generally, a company like Magna is highly cyclical, so would underperform in a recession. So I think there's two factors, like two large overhangs. So even if the tariff overhang gets alleviated from here, which it looks like it is pricing in, there is the economic overhang that I'm more worried about.
If you owned Magna, which she does, would you just hang on?
I would probably. Depends on your time horizon. So again, if we're worried about the economic cyclicality, then if you're okay to own it, if you don't need it, if you're not spending that income and you are okay to continue owning it, I think on a 5 to 10 years, you should be fine. But, if you're, I think there could be more weakness from here. Like I think it's had a strong recovery in the past few months. And so if you need it as a source of cash, I think on a short-term basis, it could go down from here.
Got it. Okay, we are going to leave it there for this block. We're going to have a look at Rebecca's past picks when we come back. Welcome back. Time now to have a look at Rebecca's past picks. These are from June 10th, so a little under a year ago, 2024. At the time, you picked Pembina Pipelines. It was 51.30 at the time. It's dropped to 50.76, not a huge drop, a 1% return drop, 6% upside in total return. We've had a number of callers ask about this pipeline and why it hasn't been doing better. How do you explain to them why it's kind of stuck?
Still my favorite pipeline. I would still recommend it today, and especially at these levels, considering, as you see, it hasn't really done anything in the past year. We think it has the best growth trajectory. It's best positioned to handle any increasing natural gas growth in the Montney, and now with Canada LNG now, shipping their first shipment overseas. They're really positioned. They have the best strategic positioning. We also own, Trap and Enbridge, but I think as we see increase, in the defensive plays in the pipelines, I think they get the most flow of funds, and Pembina gets left behind. The other thing with Pembina is I think there's an overhang with regards to their Alliance pipeline tolling in Canada, so they're in the process of recontracting that. We don't really have any clarity, but I think at this point the stock is really punishing them, and they think that there's going to be a bigger hit than there will actually be. But with regards to their dividend growth, their yield, and their capex plan over the next few years, this is the pipeline you want to own, and this is the one that we like the best.
Okay, let's get to your next past pick from June of last year, which is BCE, which we want to remind people is the parent company of this channel under the Bell Media brand. recommended at 46.64, big sigh. Now at 31.04, 33% drop in return, 24% drop in total return. They slashed their dividend earlier this year. Many had been expecting that. And we should add, telecommunications have had across the board a tougher time. Why did you pick it last year? Do you remember?
I absolutely remember why they picked it last year. Oh my God, that's a terrible chart. I don't think I'm going to get any more callers after this one. Okay, so when I recommended BCE last year, this was before the sale of MLSE to Rogers, before the acquisition of Ziply. At the time, it had a 10% dividend yield. The way I looked at it is investors were worried about their balance sheet. I figured they had so many assets, whether it's through their real estate, through their towers, through MLSE, their sports franchises, through their media, like BNN, that they could sell and fix their balance sheet. They're also going through a huge CapEx spend. They're over the hurdle of that. So like the highest CapEx has peaked already. I mean, they still have a few more years of CapEx as they're rebuilding like the fiber to the home. They're further behind TELUS, but they are past the worst of it. So eventually, those debt levels would come down. Eventually, as rates come down, that would also benefit. Eventually, as the pricing environment becomes better. So at the time that I recommended the stock, all they had to do was do a big asset sale to fix their balance sheet, and everything would have been great. And they did that. And then a month later, they
bought
announced
something else.
They bought Ziply.
Yeah.
And I think that's where you really saw the stock tumble. I think there was a lot of investors that lost faith in management after that. The Ziply acquisition, I don't think, has gone to plan. That's why they partnered with PSP with regards to future growth for Ziply. But then you kind of question, did they overpay for it in the first place if they're selling off half of that growth? At the end of the day, it's been tough to own BCE. We still own it. We didn't sell it. We're not selling it at these levels. If anything, we actually bought more at $30 because eventually we do think that, as I mentioned, they do have a lot of infrastructure assets. They could still sell a portion of their towers. They could still sell some of their real estate. They do have that flexibility. We could also see that valuation gap narrow as their CapEx build continues. And we do think, again, if we are heading to a recession, that defensive play is still a positive trend for the telcos. So we still own it, but yeah, I mean that was a tough one to take. I know. Okay. It's been tough.
Let's get quickly to your third pick from last year, Northland Power, which at the time was $24.39, has dropped to $21.94, so a 10% return drop, 5% a total return drop. Quickly on this one, if you can, just what happened with Northland Power?
Again, I am more convicted on Northland Power now than I was a year ago, but for the exact same reasons, they're just more ahead of it. So a year ago, they had 3 large projects underway. So, how it works with these projects is they spend a lot of CapEx up front, but the cash flows only come later on. So they have 2 offshore wind projects in Poland and Taiwan and 1 large battery storage in Ontario. That battery storage, and you see it bottomed and you could see the stock is slowly starting to take off. And I think it's on an upward trajectory from here as those projects start getting de-risked. So one of those projects, the Oneida battery storage, that's in place ahead of schedule, $100 million under budget. Then the second one, the offshore wind in Taiwan, that is ahead of schedule. They reached first power, I believe, last month. That's a huge milestone because that means all of the transmission lines, all of the connectivity is working. They just need to copy paste those remaining 59 turbines. And then the last Baltic Power is still on time, on schedule. They have a history of completing their projects under budget and ahead of schedule. We think as these projects get further down, the discount rate will slowly start to take effect. These projects get de-risked, and it's reflected in the price. They went through this huge build-out about a decade ago. We're seeing that same trajectory today. So I think now is actually the best time than ever to be buying Northland Power.
Got it. Okay, we are going to take a quick break. Rebecca's sticking around to take more of your questions. Back in a moment. Welcome back. Jitan's on the line from Toronto. He's got a question for Rebecca. Let's go there. Jitan, what's your question today?
Hi, good afternoon. My question is regarding financial, in particular BMO. Would you recommend that book a profit and pay capital gain tax, or continue eating the dividend? If you say yes, book the profit, then where would you park the money to get a similar kind of dividend return? Thank you. Have a good day.
Okay. If you took the money out, you're looking for a similar dividend return. Why wouldn't you keep it in?
Yeah, good question. So, and thank you for staying on the call after my past pick segment. So appreciate that. So for what it's worth, in my opinion on BMO, I think right now, especially BMO, like the banks are looking quite expensive. It's one of those things that I'll always say, you could be a good company, not necessarily a good stock at the moment. And I think that's what I feel about the banks right now. So, banks have had a pretty stellar move in the past quarter, BMO being one of them, trading at about 14 times earnings. So it's pretty expensive considering we are most likely entering a period of economic weakness. Mm-hmm. So I would probably definitely be taking profits off of BMO. It's actually, so yields about 4.3%. I think in Canada, it's pretty easy to get 4.3% by owning, you can own CNQ over 5, you can own any of the pipes, Enbridge, Pembina at over 5%. I would probably stick it into something a little bit more defensive, infrastructure, utilities, pipes. Again, you want to go into something that will outperform in a market downturn, in an economic downturn. So we stick with infrastructure that is on the defensive side. So whereas BMO is one of the more cyclical banks, and banks in general are linked to the economy, and we just think valuations are a little bit too high right now.
Got it. Okay, let's move on to Iris, who is on the line from Regina with a question. Hi, Iris.
Hi, Morella. I want to congratulate you, first of all. You're welcome and a good addition to BNN.
Thank you.
And Rebecca, I respect yours and Ryan's opinion on dividend stocks. I've been watching you both. My question is, I'm retired and I don't need to withdraw from my TFSA long term. In the TFSA, is it better to have dividend stocks in a drip or take a cash payout to buy more dividend stocks? Thank you for taking my call. And I'll wait for your answer.
Okay, thank you for the question, Iris. What do you think? Where do you weigh on that?
I love these type of questions. So thank you, Iris. I really enjoy these type of long-term philosophical questions. So what we do for our clients is the latter. So when you participate in a DRIP, you're basically buying a percentage of each stock at current market prices. So whether it's up or down, you're just accumulating, which is not a bad thing, but we prefer to have a little bit more control. So dividends come in and then we get to deploy where we want to put that cash. So as an example, we own Agnico Eagle Mines. It's our only gold company. It's up, 50% this year. We bought it, when the yield was over 3%. Now it's 1.6%. I'd rather take that money. I'm not necessarily wanting to deploy more in that stock. I'll maybe put it into something that's underperformed. So we get to pick and choose. I rather put it in a stock that has a higher dividend yield right now. So, right now I'm a little bit nervous about the market. So we are taking dividends and putting it in a money market fund as we wait for a little bit of a market pullback. So you have more flexibility when you accumulate cash, and then you can deploy it into stocks that are more undervalued or stocks that you think have a higher growth trajectory, as opposed to, dripping it and then it goes to all stocks on a equal basis.
Got it. Okay, good advice there. Let's go to Frank, who's on the line from Mississauga, Ontario. Hi, Frank.
Hi, thanks for taking my call. My question is for AQN. It's got the same trajectory as your past picks, and I'm with you on those. Just wanted to know, power. Power is a theme for the next decade. It's going to be required more and more. So this, in my opinion, this company is not going anywhere. But it's got some missteps in the past. They're trying to correct it. Has it formed a solid base now where we can start to look forward and it can start to look, recover a bit?
Okay, so question for Algonquin Power. they do sort of renewable energy?
Good question, but no, they sold off the renewables.
Oh,
so right
okay.
now they are transitioning to a pure play utility. So they used to be half utility, half renewables. They've sold off and again, this is part of their, as the caller said, there was a few missteps, management change, all that. So we're really looking at Algonquin 2.0 going forward. They actually just had an investor day last month, and the stock was up, I think, 10% after that investor day. So I really think that investors are believing into this back to the basics of Algonquin, new fresh start with a new management team, looking at a pure play renewable company. They still own some hydro renewable assets, but that's about it for their renewable position. And like the caller said, the demand for energy is continuing to increase. This company is not going anywhere. And at the end of the day, this company is the best valuation for these utility stocks that aren't going anywhere. So I don't know. We owned it. We got hit by those 2 dividend cuts in the past few years, but we didn't sell it at the bottom. We continue to own it. I don't know if we're going to own it forever, but I think they're taking steps in the right direction. They're doing the right thing, and I like to see where it's going from here. I mean, I think investors are feeling pretty confident. The stock is up almost 20% year to date, so it's outperformed other utilities because this is really a turnaround story. So
it might take a little while longer for them to.
It will take a little while longer, but I think they're doing the right things.
Got it. Okay, we do have to leave this part of the conversation there. We're going to take some more questions right after the break. Welcome back. Let's go right to the phone lines. Chris is holding on the line from Toronto with his question today. Hi, Chris.
Hi.
Go ahead.
Oh, are you on now?
Chris, are you there?
Yeah, I'm here. I was wondering about your thoughts on Rogers Communications.
Okay, thank you for the question. Rogers, again, with one of the telecommunication stocks, but going in a different direction with its sort of sports holdings.
Yep. So Rogers, I mean, you see that chart. It's not looking good, but very similar to the other telcos. I mean, we talked about it in the, all like the telcos all had the same issues in the past 2 years. We're in a highly competitive pricing environment. That's not good for anybody. We're looking at slowing immigration targets in Canada. So still growing, just not growing as much as expected. And you have a lot of infrastructure spending. Now, Rogers has the benefit of having a better balance, well, not a better balance sheet, a better dividend payout ratio because they never raise their dividend as much as, let's just say, TELUS or BCE. So that their dividend is safe, albeit at a much lower level. But we have a debt issue right now because they closed their MLSE deal. And I think a lot of investors were hoping that they were going to sell a portion of that MLSE minority interest, or, they were going to monetize some of it just to help their balance sheet. And they didn't announce that when they closed the MLSE deal. Doesn't mean it's not going to happen. It just means that it didn't happen as soon as most investors expected. So, Rogers is one of the telcos we don't own. Again, we talked a little bit about the dividend as one of the reasons why, but they have a higher debt, so they need to fix their balance sheet, And again, those sports assets, while valuable, they're not necessarily cash flow positive. So I'd like to see what they're going to be doing with that. So for these reasons, Rogers is just not one of the telcos that we own.
Got it. Okay, let's go to the phone lines. We have Charlie, who's holding from Montreal. Hi, Charlie.
Hi, thank you for taking my call. I'm calling about Capital Powers. It was recommended in the past. I did very well with it. And then I was hearing on BNN again that it seemed to have been a little overbought and fundamentally wasn't justified. So I sold it almost at 64. I'm wondering, do you recommend if I get back in it? It has a good yield, but it seems to be on a downtrend. Do you feel I should wait or start legging in?
Okay, so if you sold at 64, you did pretty well. It's down to 54 at this point, but what do you think?
I was going to say you did a good job selling at the top. The stock in 2024 was up 65%. And a lot of that was based on speculative rumors of what's happening in Alberta. So Capital Power and TransAlta have a lot of Alberta exposure. There was rumors or at least the government making announcements, or there's noise about them introducing data centers into Alberta just because they have excess power capacity at a cheaper price. It does make sense. But until we start seeing concrete evidence that these data centers are going to come, and I haven't seen anything concrete. I haven't seen, final investment decisions or anything like that. It's still speculative right now. So. The stock was up 65%. It's came back down, and it's starting to trend up again. To me, that recent move since April, I'm a little bit concerned about it. I think you could get more stable yield. I mean, it used to yield about 6%. Now it's 4.75. I think you do better owning, an Enbridge or a Pembina that has more secured growth versus Capital Power, which is more speculative growth right now. So I think if you sold it at 64, I think you did really good, and I would be a little bit more hesitant to get back in right now.
Okay, we hope that helps, Charlie. As we take a quick break right now, we're going to be back with new picks from Rebecca. Stay tuned for that. Welcome back. Time now for new top picks from Rebecca. The first one on her list is NFI Group, making industrial buses, I guess, transit buses, that kind of thing. What do you like about NFI moving forward?
Yeah, so, I spent the past hour talking about dividends, and this is actually one of our only two names that doesn't pay a dividend. And so for us to invest in a name that doesn't have a dividend, we really have to be convicted on the company and the stock price trajectory. And we are in the longer term. So as you said, the biggest segment is manufacturing transit buses. They also do coach buses as well. But they have... They had some supply chain issues in the pandemic that caused the stock to come off. And most recently, they had a supply chain issue with the seat manufacturer that is now slowly getting alleviated. But at the end of the day, their backlog is at record levels. Like, they are now taking orders into the end of 2026 because their orders are so high. They cannot produce buses fast enough. The pricing environment is good. Their record backlog is high. And they have very limited competition. Since the pandemic, I think almost all bus manufacturers went out of the business, and they're the only ones left. So I think, we've seen it run up a little bit this year because it's done so poorly last year, but, public funding still is strong. And New Flyer is one of the only company, or NFI is one of the only companies that produces that's compliant to Buy America, that produces a zero emission bus. And as companies or as transit agencies are looking to update their fleet, they're looking for lower emission options, and New Flyer is the one that produces it. So I think on a long term, this is a great company to own, and I think it's just starting to take off.
Got it. Okay, let's get to your next pick, which is Brookfield Renewable Partners on the TSX. I know people like Brookfield in general as the name, but why do you like the renewable part of the portfolio?
Yeah, so as I mentioned, through with Northland Power and other utilities, the need for energy and power demand is just continuing to increase. Brookfield Renewables, about half of their assets are hydro, which we like as a long-term asset. A lot of their growth, they have U.S., international, so they have a lot of diversification with regards to their geographies as well as their as the type of power. But what I think is the company's really been overlooked. Like last year in 2024, they signed the largest ever corporate clean energy deal with Microsoft for 10.5 gigawatts to build wind and solar through 2030. And the stock really didn't do anything. I mean, once complete, that's going to increase their production by about 33%. They also own, with Cameco, a percentage of Westinghouse, which they do the servicing of nuclear power plants. And again, we are bullish on nuclear power. We're bullish on any kind of, clean, lower emission power that's in demand right now. So I think, based on those two business segments, I think it's poised to do well. And with a 6% dividend yield that's still growing 5% a year, even if it takes longer to achieve, we're happy to wait and see. But I do think it'll take off from here as well.
Got it. Okay, let's go to your third top pick, which is Premium Brands, again on the TSX. What do you like about Premium Brands?
Yeah, so again, I'm not a fan of retail stocks, particularly discretionary stocks. Mm-hmm. But in this case, Premium Brands, I think, they it's a turnaround story, and I think they're on a trajectory of growth that's going to be completely agnostic of what's going on in the economy right now. For the past few years, they've been spending millions of dollars on U.S. expansion. So they have, for example, a client, let's just say like Costco in Canada. They've been doing really well, as Costco is one of their biggest clients, and now Costco USA is asking them to put products on their shelves. But to build that out, they have the orders, but they just don't have the capacity. So for the past few years, they've been building out their U.S. warehouses to build expansion and flexibility, and that's almost done. So it reminds me a little bit of like a pipeline. You put the capital expenditures first, and then the EBITDA comes later. And I think in this case, investors got a little bit impatient, whereas we're patient long-term investors. That CapEx is almost done. You're starting to see it. They've had 2 really strong quarters of earnings right now. You're seeing that growth in the U.S. starting to take off. But once that capacity starts to be, once that capacity build out is complete, you're really going to start to see some growth on the U.S. side. It also got hit recently with tariffs, but they're pretty tariff agnostic as well, because their cross-border is very little, because they have production in the U.S., production in Canada, and not as much cross-border. So I think the company was a little bit misunderstood during the tariff uncertainty.
Very quickly, do they pay a dividend?
They do pay a dividend. I think it's about 3.5%. Okay. They usually grow it at about 10% a year. They didn't announce a dividend growth this year, but I think it's because they just have so much going on the growth side. They also did like 3 or 4 M&As in the past 6 months. So they're doing a lot of good things, and we're happy to wait on that dividend growth if it means EBITDA growth going forward. So.
We do have to leave it there. Rebecca Teltscher, thanks for joining us. Appreciate your time.
Thank you.
And that is it for Market Call today. We'll see you again tomorrow.